What's going on, everybody? I am back for round two, kind of continuing where I left off last night on the prospectus and how to read and analyze one. I'm going to be going into something a little bit different, but also quite similar in your investment thesis, or at least the developing an investment thesis, and looking at the asset allocation of a particular fund that you may be investing in. So let me get into the outline as I start. I'm going to go over the rule of 72 again for long-term investing. I did a whole video on this, but I'm going to go through this and show you how it plugs into what I'm about to discuss with asset allocation. And then we're going to dive into an annual, a semi-annual report and the differences between the two, what you can find within. And then we're going to look at two funds. One, the same fund we looked at last night, which was American Century Fund's small cap value fund. And then I'm going to go into a different one and show you the difference between the two, trying to compare apples to apples a little bit and showing you the difference in these annual and semi-annual reports of how these funds actually allocate their assets. So let's go into the rule of 72. This is the basis for everything I teach my clients and everything that I do when I actually come up with an investment thesis. If you have not seen my video on the rule of 72, you don't have to after this, but if you'd like to dig in a little further, it was the second video I did way back in March of 2024 BC, it seemed. So the rule of 72 is called the money and banking rule. And it's a formula that will give you an indication of how many years it will take your money to double, depending on the interest rate that you're investing in. So, for example, if you want to invest $10,000 at 3%, 6%, 12%, let's start with 3%. You would divide that 3 into 72 and you come up with a number. That number is 24. That means that $10,000 that you put into your 3% vehicle will double in 24 years to 20 grand and then double in another 24 years to 40 grand. Now let's up the ante a little bit and hit the 6% column. Same rule applies, same amount of money, same amount of time. You divide 6 into 72, and that comes up with 12. Now your $10,000 is doubling every 12 years to 20, 40, 80, then 160,000 by the end of the 48 years. Remember, same amount of money, same amount of time, just a different vehicle. Now, what happens when you put it into a 12% vehicle if we want to up the ante a little bit? Well, now we're going from the tens of thousands or the hundreds of thousands to where you apply the same rule, same amount of money, same amount of time. 12 goes into 72 6 times. So now your $10,000 is doubling every 6 years, and you end up with $2.56 million at the end of that time horizon of 48 years. Now, the question becomes, how many doubling periods do you have left in your lifetime? And that's the way you should be looking at this rule and thinking of it, because most people just say, this is the way you don't think about it. Where do you get a 12% rate of return? Listen to me. The rule of 72 is a rule that the bankers use. It's the rules that credit unions use, and it's a rule that insurance companies use to screw you over because you invest with them your $10,000 at 3%. They walk it over to a guy like me at 12% to invest it. And at the end of the 48 years, the banks, the credit unions, and insurance companies end up with $2.5 million, and they cut you a check for 40 grand and they keep the rest. So what we're looking to do is use this rule and flip it on its head and flip it against those industries to see how it would benefit you. And that's the purpose of this video and a continuation from yesterday on how we're going to go forward with that. So think of how many doubling periods you have left in your lifetime and then develop your investment thesis on that notion. So if you only have 6 doubling periods left or 5 doubling periods left, count them in that right column in that 12% and see what you could get to depending on the money that you're going to be investing. So when we're looking at funds to invest, yesterday we went over a prospectus because that has to be delivered in order for a potential client to make an investment choice. The annual report is kind of the other half of that phone call. The prospectus was only listening to half of it. The annual report gives you everything else. So what this is in the investment world is a source of multi-year fund data, performance, and asset allocation made available to shareholders and prospective clients. When you look at some of the regulatory compliance literature, you're also going to see something called a semi-annual report, pretty much the same thing as above, except it only covers the first 6 months of a fund's fiscal year. So the annual report obviously covers the entire year. That's why it's called an annual report. So we're going to look at two different growth funds. Remember my bucket that I put these in on what I consider an aggressive growth fund, at least 11% rate of return. And yesterday we looked at American Century Small Cap Value Fund, ACSCX. That's a mouthful. And since 1999, my rules were at least 25 years, showing 2 to 3 years of growth with one down year. That's going to happen. And it also has to fit into the investment um, thesis of what you're investing in. If you're investing for retirement, keep it long term. If you're looking for income, you want something a little more conservative. Usually the breakdown is going to be about 98 to 99% equities and then 1% non-equities. This is an aggressive growth small cap value fund. When we look at the asset allocation in this annual report, we're going to notice something interesting is that you're probably not going to notice most of the companies in there because they're small cap companies. They've got the most room to grow and turn into medium cap or large cap. So again, this is where the risk comes in. In this case, American Century has pretty much been in line or a little bit outperformed what I would consider an aggressive growth fund by a 11.15% rate of return for 25 years. Pretty good. Now, we're going to contrast this with the behemoth of where I would allocate a growth fund, 9 to 10% rate of return. American funds, that's different than American Century. American funds is a monster, and the Growth Fund of America is a monster growth fund, AGTXH. Since 1973, this is the rate of return that is average. So we're talking 51 years, 12.86 rate of return. Usually growth funds are in that 95, 96% equities with 4% dealing in non-equities. And one of the reasons is because they spread it out quite a bit in a lot of established companies, which allows them to speculate a little bit on some smaller companies that have room to grow as well. But American funds specifically, when we see the report and we see the numbers, we're going to see how many shares they have of these funds that they're investing in and these equities and holdings that they're investing in, and not to mention the net value of the company and the fund itself. Pretty eye-opening and a very big difference between these two. Now, disclaimer, as I mentioned last night, I am a licensed financial advisor, but I am not recommending one or the other to buy, sell, trade, liquidate. I'm only using these to compare and contrast the difference between these two in the confines incidental to my career as an educator. Disclaimer, because I have to put that in there apparently. All right, so let's take a look at each one of them. American Century and then American Funds. So I'm going to go to American Century. So this was the overview that we showed yesterday on the website that we went to. I always said go to resources and then stay away from fact sheets, small children, stupid people. Go to the annual report, which is right here. Summary prospectus. I always say go to the prospectus. Then you have an annual report and a semi-annual report. So we'll go to the annual report, show you what that looks like. This was published just looks like almost 3 months ago, so 2.5 months ago. So that's their time when they publish it. They'll publish the semi-annual report sometimes in September. So going there, we're going to look at, here's the table of contents. We're going to look at the schedule of investments. Let's go down there. President says hi. We saw everything from that we needed to on the sales charge and the period of performance over the past 10 years with the prospectus yesterday. So here's again, the fund characteristics, the breakdown. What I say, about 99% are stocks and the other ones are very short-term investments. And they also list the industries. 1/5 of these are in banks. The rest of them, oil, gas, financial services, machinery, trading companies, and distributors. We'll take a look at what holdings they actually have. A typical growth fund has about 150 to 200 holdings, sometimes more. Just depends on what they're investing in and what they're putting your money into. So here we go. Schedule of investments. 99% are common stocks. And when you look at banks, you may have heard of Ameris Bancorp. You may not have, but look how many shares they have. 1.4 million, valued at $69 million. So you can sit at home and try to create a similar portfolio for an aggressive growth fund like this, but where are you going to get the money to get those kinds of shares? The difference is investing into the mutual fund itself, you get to experience the rate of return and the growth that it has. But remember, when you invest in a mutual fund, you do not have ownership of these underlying holdings. You don't have stock in Columbia Banking System Inc. simply because you own a share of the American Century Small Cap Value Fund. So again, I don't know if you've heard of half these banks. I'm going to say no, I have not. They're probably smaller banks, definitely with room to grow in a system that is not in the Merrill Lynch's and the Bank of America's and the Wells Fargo's of the world. They have some spread out in building products, chemicals, commercial services and supplies, containers and packaging. I haven't heard of half these things, and they're small cap. That's why. I mean, but look how many shares they have of Alit Incorporated from Electric Utility, 610,000 shares, valued at 36.3 million. Electronic equipment they invest in. I have not heard of any of those companies. Financial services. I am in the financial services industry and I have not heard of any of those companies. Gas utilities. Maybe if you live in the Southwest, you probably have heard of them. Let's see if I've come up across a company that I recognize. Dave and Buster's. There we go. So hotels, restaurants, and leisure, 2.9%. They have 895,000 shares of Dave and Buster's. In a small cap value fund, I found a company that I'm familiar with. But maybe there's other things that you're familiar with. Is that just understand that if you're going to invest in a small cap fund, you're not going to recognize the holdings that they have. And as we go down and all the way through, and then obviously the short-term investments they have are in money market funds and repurchase agreements. And here is the total net assets, 5.9 billion. Now that sounds like a lot of money, and it is. But when we get to contrast this to American funds, not American Century, but American funds, you're going to see a very big difference between these two. So let's move on to the Growth Fund of America, the behemoth that it is, AGTHX. If you want to be on their regular page, you can see their mix, 87% in U.S. equities, and then they have about 9% in non-U.S. equities, and they should be able to show you a map of where those are too. I think I saw one of those. Sometimes they put, yeah, okay. So, for trying to get exposure outside of the United States markets, you could do well to look for funds maybe in your investment thesis that would put some of your money into European markets, Asia markets, or Canada, Latin America, and elsewhere. So back up to here, and yeah, you're seeing 87%, 9%. So that's about 96% right there, almost 97% of equities, and then their cash equivalents, their non-equities, are about 3%. It's a growth fund. It's not aggressive growth. Let's take a look at the annual report for the Growth Fund of America, and this was published August of last year. So their semi-annual report was probably published earlier this year, probably in February. But let's take a look at the annual report. And again, similar to the one we looked yesterday, the prospectus had the sales charges and the past 10 years of performance. So you've got that, looking into that. Pretty pictures. Let's go down to where these holdings are. So it gives you a kind of a sector diversification. If you're looking at that, the last one had 20% in banks, and then the rest of it was spread out in different industries. This one has 22% in information technology, and then spreads the rest out in consumer discretionary spending industries, healthcare, industrials, communication services, and other sectors. So largest equity holdings, as you can see, Microsoft, Alphabet, Meta Platforms, Amazon. These, now we're getting to companies that we've heard of. Look at the common stocks in the information technology that they're investing in. Microsoft, Broadcom, Apple, Synopsys I've heard of, Motorola. Now you're getting into a growth fund that isn't a small cap focused, but one that invests in companies that we've probably come to know, at least as brand names anyway. Let's go to consumer discretionary. Amazon and Tesla, Airbnb, Royal Caribbean Cruises, Home Depot, Chipotle. So these are, again, investing in this. And look at the shares. You're talking 53 million shares of Amazon. And these are, if I'm not mistaken, these are valued in the thousands. So whatever number you're seeing here on the valuation of it, add 3 zeros to it. That is not 13 million in Microsoft stock. That is 13 billion in Microsoft stock. Let's keep going. Consumer discretionary, healthcare. What do we got that I've recognized? Interestingly enough, and I used to actually work with healthcare distributors. That's funny. Don't recognize those. All right, moving on. Industrials, Delta Airlines, Axon, I recognize. Canadian Pacific, Kansas City, whatever the hell that is. Equifax, I think we know who that is. Northrop Grumman, definitely. Communication services, T-Mobile, Netflix, Verizon, Frontier Communications, Zoom Info Technologies. These are all, again, when you get into financials, now you're dealing with MasterCard and Visa, where they have these shares and this is their valuation. And when you get down to it, again, 96% of these are in equities. This is from the annual report. And then they have stuff in money market for, cash equivalents. So it's not all stocks, but it is a growth fund, but they have short-term money markets are securities. So it's short-term securities to balance out what their growth equities would be. Now, let's get down to the last one that we were at was 5.997 billion in total net assets. Let's take a look at what American Funds, Growth Fund of America, has in total net assets. Yeah. And remember, this is dollars in the thousands, just to let you know. 235,326,035, add 3 zeros to that. $235 billion in net assets. If you're talking David and Goliath of the investment industry, regardless of the rate of return and the performance, both have done very well. Both have done very well over a 25 and 50-year period. But you can see the size and difference between the two just looking at American Century versus American Funds, which is, pretty much the Michael Jordan of the mutual fund world. Now, with that, I'm going to wrap it up and get to current slide. All right. So I showed this to you in the sense of if you're digging into the regulatory documents and into the financials of companies, you want to be, you want to be secure in what you're investing in. You want to be comfortable and confident as well. So remember to use the rule of 72 in an advantage to you to benefit you, not to benefit the banks, the insurance companies, and the credit unions. If you want to check the prospectus, as I mentioned, check it for that past 10 years of performance and do the compounding interest on your calculator like I did last night to show you, had you invested that amount of money over the past 10 years, here's what you could have gotten. It doesn't mean the future is going to hold that because past performance doesn't indicate future returns, but at least gives you a starting point to get to that 12% column on the rule of 72 so you can start to actually grow assets and grow your money. And then if you want to check what the fund is actually investing in, check the annual report or the semi-annual report for that, and it'll show the asset allocation. It'll show the industry breakdown. It'll also show you, like I showed you on the American funds, that map of what other countries they're investing in. So it's not just American markets. So I'm going to go into further videos that show you a whole different world of what to use these funds and how to use them. Maybe not on the aggressive growth side unless you want to retire, but for short and medium term investment goals that you may or may not have. And that way you can actually plan and forecast this out to where the money's compounding on itself. So you're not constantly shoving money into short and medium term accounts. You're letting it grow and compound for you because we know the banks ain't doing it. So hope this was helpful. Hope this was useful. Giant hugs.